Next guest on the show, Sunil Koul, Global Emerging Market Equity Strategist at Goldman Sachs, is joining in. And like I was just telling you from Sunil's latest note, some of the headlines on earnings, they perhaps look not that negative. Sunil, great to have you on. Thank you for joining in. As we started the show, I was just giving viewers some of the highlights. Out of the 90 MSCI India companies that have reported, you point out in that note that 39 companies have beaten estimates, 44 have missed estimates. And the misses are not like by a huge margin. They're like 1-2% misses. So that gives a sense that, yes, this has been a subdued first quarter, but not a washout one. You tell us, what's your, summary of the earnings, the management commentary, the read-through so far?
No, I mean, you're right, Surabhi. I think the numbers are holding up much better. I mean, to be fair, I think they're in line with what we and the consensus were expecting. I think we sort of came into the year thinking that earnings growth will be 10-11%. And so far, I think that's what it is tracking, around 10% year-on-year profits up for MSCI India as a whole. I mean, there have been sort of some, as you said, at the margin, a little bit more misses than beats, but on average, this is like 1-2% misses. So we would say it's largely in line so far, but it's kind of in line with expectations. And that's something we are seeing broader across the region, which is like consensus expectations have been sort of generally low, and the numbers are coming in sort of in line and meeting those expectations. So India, I think in that sense, has been kind of in line. The other bit, which is more important, you mentioned in terms of management commentaries, I think there is generally sort of more confidence we are getting listening to the commentaries that people are feeling more confident about the consumption recovery. I mean, I think there are at least 3 or 4 large FMCG companies that have reported that they are seeing slightly better mass urban consumption picking up. And I think that's an encouraging sign. It's not sort of broad-based, to be honest, at this point. I mean, in terms of the consumption categories, we're not seeing it as much in autos or durables or paints. But staples, for sure, I think so far it's been encouraging, especially the mass urban low ticket item is clearly kind of seeing improvement, which has been our expectation. And it's good to see that coming through in the earnings season so far.
Okay, so that's great news. I mean, it's great news. It's a great silver lining to an otherwise very cloudy market sky, Sunil, because the market has been testing investors' patience, right? And there's very little good news. There's tariffs on one hand. We'll talk about that in a second. But what you're saying in terms of some, shades of recovery, mass consumption, etc., what does that, I mean, where does that leave us? So is this an earnings pivot? So should one be prepared for a much stronger second half and therefore maybe a market rally resuming? Or does this just mean that at least we have a bottom in place? So maybe a couple more months of time consolidation.
I think clearly the latter. I mean, it has been our expectation, Surabhi, as you know, I think last time as well, is that we are calling for an earnings cycle to bottom out a couple of months back. And we did expect the second half of the fiscal to be stronger. And I think, as I said, it's encouraging to see that view is starting to pan out. I mean, to be fair, multiples are expensive. It has been for a while, but it's very little. But I mean, in terms of our return expectations, we don't think the market can have further multiple expansion from current levels. And in that standpoint, earnings becomes the critical fuel for the market if it has to make more gains over the course of the next 12 months. And in that sense, the earnings cycle being bottoming out firmly and possibly seeing recovery in the second half would be a good sign.
But that means, again, since you said it doesn't necessarily mean multiple expansion, what does that mean for overall, market price action? 5% flat, or just, go back to old highs? That's the best case scenario for this calendar year?
Look, I mean, in terms of our expectations, we are baking in 27,000 on Nifty on a 12-month basis. So that will take market to new highs. But that's from current levels, only 9% upside. And our earnings growth numbers are roughly around 11-12%. So we are baking in a bit of multiple compression in our numbers. But if you are right that the earnings do grow low double digit, that should take market higher over the course of the 12 months. And so we do think market goes back to highs. But I think the near term, we'll probably come to tariffs in a bit, but near term, it's going to be a little bit sort of challenging given sort of the news flow around tariff, given not that great seasonality, not specifically for India, but for broader markets. And that probably means for the next few months, the market kind of range bounds in here. But as we get into festive season, we get sort of more clearer signs that things are kind of picking up. You could see a rally into the year and further gains there.
Sunil, now on the global piece as well, and I'm curious to know what you've been hearing from a lot of the conversations that you have, international clients as well. Because first it was the US market was, doing so well that you didn't want to go anywhere else. And then again, it was the US continued to do so well despite all the tariff headlines. And now the US is not doing well because of, let's say, the job report on Friday. But again, the futures are up because now you'll hope that the Fed will start cutting. So again, you go back and buy US assets. So this whole US exceptionalism, so far it's not ended. We've paid the price in terms of, lackluster FPI flows. What do you see ahead next couple of months?
Look, I mean, I would sort of push back on that a little bit in the sense that yes, the US market has had a few sort of exceptionalism early in the year. People thought it's dead, and now sort of markets have gone back to all-time highs. But I think if you look at emerging market as a whole, we have had a pretty strong run despite kind of US equities going back to highs. I mean, emerging markets have rallied sort of 15% in the first 7 months of the year. That's the strongest it has done in terms of January to July performance in the last 7-8 years. FII flows, to your point, I think from the April lows, we have seen close to 40 billion come into the broader emerging markets. And obviously, India has been a bit laggard, partly to do with the fact that sort of growth was kind of still slowing and earnings were still in the down cycle, partly because of elevated valuations. But to say that because US has gone back highs, the entire exceptionalism story is kind of come back in terms of your assessment, I think that's not entirely true. I think from our client conversations, we continue to see a lot of interest from clients trying to diversify away from US and trying to build up broader emerging market exposure, which is why if you sort of look at the flow data broadly, it's been 10 weeks in a row where emerging market funds are actually seeing inflows. And so I think we continue to see, therefore, momentum of people diversifying. India, unfortunately, hasn't been a large sort of gain from that trend. But we still believe that overall money will continue to come into the emerging market as a whole, and some of that will also trickle down into India. I think as the fundamentals improve, that should get us further inflows.
Yeah, that was the second part of my conversation, that even when people have diversified away from the US, they've been going to South Korea, and there's always the China question because valuations are so great there.
Yeah.
But now with the kind of earnings that we just discussed, I mean, in the first part of our conversation, if we don't have more earnings disappointments, then do you expect FPI flows to pick up?
Yeah, we would certainly think so. I mean, I think for India, it is a growth story. I think given where multiples are, we do need, and that has been our view all along, we do need sort of earnings growth to come through. And I think now we're feeling a little bit more confident that is coming through in terms of consumption recovery. And that should be the fuel for FPI flows to come in, market to do much better in the second half of the fiscal as well.
Okay, so let's come to the portfolio call as well, Sunil. And I mean, you put out that stock-specific sensitivity analysis as well, because we have this tariff situation to deal with. And let's start with pharma, because on your list, obviously, there are a couple of pharma companies that are most vulnerable if we get further news. So from that respect, have you made any significant changes to the portfolio construct because of this whole tariff situation?
I mean, we have not made any major changes to the portfolio or the sector allocations. I mean, we have made some changes to our sort of headline numbers, both in terms of growth and policy. I mean, just to sort of make sure we're on the same page, Surabhi. So after the tariff announcements, we did shave India's GDP growth numbers a tad, sort of 20 basis points for this year, 10 basis points for next year calendar. So we're now looking for India growth a little weaker in terms of 6.5%. But at 6.5%, it's still going to be far greater than many other sort of economies around the world. And a large part of that is not because we think, I mean, these high tariffs will remain. We do think that there is a scope that they will be negotiated lower, as is the case with many other large trading partners US has had. But it's more the impact of uncertainty over the next few months till we get through that, which is we are baking in our numbers. We have also penciled in one further rate cut in our numbers in Q4. We don't think the RBI cuts in the August policy, but we do think that in Q4 there is a chance for RBI to cut once more. So that also would be helpful for equity markets. And then I think from the earnings standpoint, we already had baked in some impact of around 15% reciprocal tariffs, 25% on pharma. So that was already in our numbers, which is 11-12% earnings growth I mentioned. So we haven't made any incremental changes. But I would say depending on where the final numbers land, every 5 percentage point higher sort of tariffs on India does put roughly sort of 1 to 2 percentage point incremental drag on EPS. And obviously, the sectors that are most impacted are the export sensitive sectors like autos and pharma and sort of industrials and chemicals as well. The way we sort of look at it is not the direct first order impact, because if you sort of looked at goods exporters, only 4% of the exposure is to the US and demand. Only 2% of the MSCI India sales actually comes in from the goods exporting sector. So the direct hit is actually not that huge.
Correct.
It's the second order impact from growth slowdown, which will impact some of the sectors, which is what we are kind of baking in. So the sensitivities I just mentioned is kind of combining the first order as well as the second order.
Got it. So Sunil, finally putting it all together, all things equal, tariffs, expectation of RBI cuts, etc. Right now, which are the top overweights? And where should the money go? Is it financials? You mentioned consumers and the pickup in commentary on the consumer side as well. So just tell us, top overweights.
Yeah, I mean, the reason we didn't make any changes in our allocations is because we have been overweight consumption pockets, sort of staples, bits of discretionary, autos, and financials, and we have been underweight export-sensitive sectors like pharma, as well as industrials, for example. And I think that trend will continue. I think the market has started to price that already in the last sort of month or so, wherein we think both sort of consumer-sensitive sectors plus financials do much better than sort of exporters and the industrials, which also get impacted because of some export exposure, but also the ongoing uncertainties. And I think that sort of divergence within the market will continue in the near term.
Okay. All right, Sunil. Great conversation as always. Thank you so much for joining in and giving us a complete perspective on all the moving parts, including tariffs, the impending RBI policy, and of course, how earnings season has played up. And not too bad if you go by how Goldman Sachs is reading the numbers and the trends. Thanks very much for joining in. Well, with that, let's shift the focus.